You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mish Shedlock, editor of Mish's Global Economic Trend Analysis, the website globaleconomicanalysis.blogspot.ca. Welcome to the show, Mike.
That's a pleasure to be on, and it's .com in the U.S., .ca in Canada.
Yes, but there's dots everywhere. As long as you get either .com or .ca, you're going to get something.
The easy way to find me, no matter where you are, is just do a Google search for Mish, M-I-S-H. That'll take you to whatever blog I've done. And by the way, did you know why Google did this? It was forced on Google. They didn't want to do this, but countries wanted the right to censor various blogs. So Google's only response was to not give them the right to censor, but they gave them the right to go out and chop out a post if some countries objected. Now, my whole entire blog is banned in China, by the way, so, and that's probably what's going to happen elsewhere, but, all this, it's just absolutely nuts, the contortions that Google has had to go through here to be in compliance with EU censors, with China censors. Even New Zealand and Australia have their own frickin' version of my blog, and all that differs is the suffix and whether or not these countries decide to ban some article that I wrote. Amazing.
The U.S. dollar's had an unprecedented rise in value over the past year. Is there anything else that could compete as a currency against it?
Surprisingly, gold was the second top performing currency of 2014. Now, how many people know that, Jim? Not very many. If you consider gold as the currency, and the U.S. dollar was the world's strongest currency last year, the gold declined about 5% from the beginning of the year to the end of the year in terms of the U.S. dollar. Every other currency did worse than that. Gold was the second strongest performing currency, if one considers it a currency, and actually I do. And so far this year, 2015, it's doing well. It's actually risen along with the U.S. dollar this year. That's pretty good. So we'll see. My actual forecast is for gold to rise with the dollar for a while, and then as soon as the Fed decides, you know what, we're not going to hike, or we're not going to hike as much as everyone thinks they're going to hike, I think we're going to see the dollar sink, and gold will really shine in the second half of the year, if these rate hikes that everyone thinks are coming don't in fact come. And actually, I don't think these hikes are coming, and or if they do, they will be in the amount that everyone expects.
The European Central Bank is planning a big stimulus plan announcement January 22nd. What kind of announcement is expected, and will it make any difference?
Oh, okay, well, it'll make a difference. Actually, it'll make things worse, but which is what I said yesterday. They are considering three options, supposedly. This was leaked to the Dutch press, and they're going to buy government bonds in proportion to the quantity of the member shareholding. In other words, they would buy more German bonds because Germany's the largest country, France would be second, Spain, Italy third, Spain fourth, etc. The second option was to buy AAA government bonds, driving yields down to zero or negative territory. The weird thing about that is they're already negative in Germany, and heading that way in other places. They're negative in Switzerland also, but that's not a Eurozone country. And then the third option was just a different flavor of the other ones, was instead of the ECB buying it, having the national central banks do the buying, so the risk in principle would remain with the country. Lovely. The banks in these countries are already loaded up to the gills with sovereign bonds, and option 3 was going to load more of that risk onto countries that already have enormous risk holding their own government bonds. So those were the 3 options. I suspect, and I reported yesterday, that I'm suspicious of this leak, but I don't know, maybe it's accurate. It could be accurate. That Draghi is going to pull something out of his sleeve to try and shock the markets. You know, these bankers all have this shock and awe theory that if you pull out this bazooka and fire it, that it's going to do something. But I see 8 major problems with this. They've got different fiscal policies in the member Eurozone states. There's widely different work rules and widely different productivity. There's widely different social agendas. I mean, look at compare France, say, to Germany, and the pension arrangements in Italy, Greece don't look anything like what they do in Germany. And as a result of those 3 things, the one-size-fits-all interest rate policy of the ECB cannot work. And then regardless of what Draghi says, there's no real fiscal banking union in the EU, and no monetary union has ever survived without such unions. Numerous European banks are undercapitalized. The European peripheral countries have debts that cannot possibly be paid back. Actually, I think France has debts that can't be paid back. But everyone at least sees it for the peripheral countries, and when the peripheral debt rolls over, the other countries are responsible for picking up portions of that piece, so the whole thing collapses like a house of cards. So the idea that all of these structural issues can be fixed by lowering bond rates when bond rates are already negative in Germany is ludicrous, in my opinion. But that's what they're going to do, because that's what they do. They print money and they lower interest rates as a matter of course when they want to try and prevent deflation. And of course, you probably saw the headlines today, right? Eurozone is now officially in deflation.
Yes, and is that a bad thing or a good thing?
Well, to the central bankers, that's a bad thing. To all the economists, the Keynesians, the Krugmans out there, all think that this is a bad thing. The irony is, it's actually a good thing. No bank has ever been, or consumer has ever been hurt by deflation. And I'm talking about consumer price deflation. I've challenged Krugman, and I don't expect a response because they can't do it. But I've got a challenge out there. I'm asking any economist to provide any sort of reasonable proof that rising prices constitute some sort of overall economic benefit. Now, they do benefit people with the first access to money, and they do rising prices benefits people who have assets. Well, who has the assets, Jim? It's the already wealthy, and so the central bankers are out there lording it over on everyone, and Janet Yellen is particularly concerned about wealth inequality. Well, central banks are causing wealth inequality. But anyway, so here the ECB is actually the Eurozone went into deflation today by some tiny little bit, and all of it was on the basis of a huge decline in energy. And now all these economists are out there making statements. For instance, James Ashley at RBC said the far more important question is why inflation is anywhere near zero in the first place. That is how these guys think. And that's how central bankers think. And that's how Keynesians think. But what I think is what bankers ought to be worried about is asset price deflation, not routine consumer price deflation. And the irony is that by fighting routine consumer price deflation, they create asset bubbles. We are in one of the biggest, possibly the second biggest asset bubble of all time. The 1929 bubble stock market, right before the Great Depression, was bigger, and so was the dot-com bubble in 2000. However, the dot-com bubble in 2000 was mainly around dot-com stocks, Now every stock, nearly every stock in every sector is, orders is just way overpriced. So we've got asset bubbles in stocks, we've got asset bubbles in bonds. What else do you call it when you've got negative interest rates and you've got interest rates in France on 10-year below 1%, in Germany below 0.5%, in Japan below about 0.25%, in Switzerland about 0.2% on a 10-year bond. That's really quite amazing, isn't it? And their intent is to drive bond yields lower. So, here we are in bond bubbles, in junk bond bubbles, in equity bubbles, and all because central bankers are trying to fight routine consumer price deflation. It is absolutely amazing, and these bubbles are going to pop. And when asset bubbles pop, that's what's really damaging to banks, because banks have made loans on overly inflated asset values. That's exactly what we saw in the housing bubble worldwide. And these guys can't figure it out. It's amazing, Jim.
Because I recall, well, I don't personally recall, but in the 50s we had deflation, and yet people said we never had better economic times. Houses were affordable, cars were affordable, everybody had a job.
If you go back to some periods in the 1800s, we had very stable dollar. We had deflation. We had large productivity boom. You look back at not Cool Cow? Who was in the 1920s? We had a president that everyone was all up in arms that he needed to do something. He said the best thing to do was nothing, and we had a boom in the early 20s that got out of hand because central bankers let inflation go out too long. And imagine if these guys would have actually stoked it in 1920, like a lot of people wanted to. It's central banks interfering in all of these policies that caused actually the Great Depression. The Great Depression was not caused by central banks' failure to lower interest rates soon enough, as some people claim. The Great Depression was caused by the buildup of asset bubbles in the first place, and the Fed's one-sided policy response to it, of always acting in response to bubble busts and never doing anything before it. We did it with a dot-com bubble. We did it in 1929. We did it again with the dot-com bubble. We did it again with the housing bubble, and we did it again now. The third time here in 14 years, 2000, 2007, 2014. Here we are in a massive bubble, I believe, ready to pop. We'll see. And Draghi's out there trying to prevent deflation. It's actually too late to prevent it. They have caused, with this asset bubble that's guaranteed to pop, is guaranteed to bring more deflation with it. The damaging kind of asset prices falling on which loans have been made.
We'll have more with Mish Shedlock right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mish Shedlock, editor of Mish's Global Economic Trend Analysis. Mike, I'm just wondering, somebody said to me, what's happening with the price of oil is the first time we're actually seeing real markets work the way they really do work, because there's no way for government, central banks, to interfere with it.
That's actually an interesting point. Well, but it's also I would say it's somewhat true, but in a way it's a little false. The central banks actually caused oil prices to go up with their inflationary policies, their boosting of assets. That in turn, and the junk bond market was on fire. That's what enabled all of these frackers to go out there, borrow money, and do all of this drilling. All the borrowing money and the drilling, in spite of a slowing global demand, is actually what caused the prices to crash. And central banks are unable to actually do anything about that. The junk bond market is these frackers are hugely dependent on the junk bond market, and the junk bond market is bursting. I think it's going to spill over into these other areas, but yes, other than causing this artificial boom and then the artificial boom in energy on top of it, yeah, there ain't not much they can do about it now, right? And we're going to see there's not much we can do about it, right, when this spills over, possibly into Greece when they walk away from the Eurozone. The ECB says that, and Germany says, well, we're not too worried about this. We're better prepared to handle this. We're talking about 245 billion euros of debt, and Spain's portion of that, should Greece walk away, is something like $30 billion. Where are they going to get $30 billion? Where's Italy going to get its share? None of these countries have any possibility of raising these kinds of amounts. So it's all a bluff. Everyone thinks they can bluff the other guy here. I don't know, maybe it's like chicken. Who's going to blink first? There's a decent possibility no one blinks here, and Greece is forced to do what it says that it's going to do, and that's default. So we'll see just how well the ECB is. How much the ECB is prepared for this, and with China slowing, with Europe's going to be back in recession. If it's not in recession now, it barely avoided one. I think growth for last year was something like 0.2% or something. So it's not going to take much of a spillover for even Germany to go in recession.
With so many people in Europe trying to march to their own drummer anyway, is the European money union going to blow up and everybody's going to go back to having German marks and drachmas and lira and so on?
It'll be interesting how that plays out, and I don't know the answer. What I do know is what can't be paid back won't. The smart way to do this actually would have been to let Greece exit the Eurozone 4 years ago. It had debt something like $40 billion, maybe 50 or 60. I forget the exact number. Now it's got to pay, to prevent a default on $40 billion, they've thrown another $200 billion at it. It has $245 billion now in bailouts that can't possibly be paid back. Greece is in a current account surplus state, a primary current account surplus state. That's it's got an inflow of money now, with considering that if they didn't have to pay interest on the debt, which of course they do, but ignoring interest on the debt, or if we just say interest on the debt was zero, it would take Greece 81 years to pay back $245 billion. Is this a realistic scenario?
Well, it sounds like the average person's credit card bill. If you just do the minimum payment, it's going to take you 81 years to pay it off.
Yeah. Well, actually, they've got a minimum payment amount now in the U.S. So you would eventually pay it off even at 0% interest rate. But yes, it's the same kind of principle. But anyway, you asked me how it's going to, break up. What we know is these debts can't be paid. What we don't know is who's going to be held responsible. The sensible thing would be actually to forgive some of these debts because, and let any banks that are loaded up in these bonds, sorry guys, you were stupid. You shouldn't have bought these bonds. Let these banks go under. That's what ought to happen. But it's highly unlikely, I think, that is what's going to happen. So the possibilities are that politicians actually manage to keep this damn thing together longer than anyone thinks, and in which case insisting that all of these loans are paid back, and these countries actually try and do that, well, you're just going to see stagnation in the Eurozone for the next 15 years if that happens. And at the end of that period, then these banks would probably be strong enough to realize, this debt can't be paid back, let's write it off now. That's scenario number one. That's 15 years of pain or so. Scenario number two is a destructive breakup of the Eurozone when we see a cascade. We see Greece leave, then Spain leave, then Italy leaves, or, just out of the blue, some politician like Marine Le Pen wins in France and says, we're taking France out of the Eurozone. That collapses the whole thing. Or Beppe Grillo in Italy. So, the third thing that could happen is that Germany actually sees this coming and Germany exits and lets the rest of the Eurozone do what they want. Germany will pay a price for that. It would get paid back in deflated euros. The value of the Deutschmark would soar, and so somewhere or another, Germany thinks it's going to escape punishment from this. Somewhere or another, Germany is actually going to take a huge hit for this. But the least destructive way would actually be for Germany to actually, exit the Eurozone, let the rest of these countries, that want their socialist policies to have it, and do what they want. But one way or another, Germany is going to pay, or they all just pay, and all suffer through together for 15 more years of very, very, depressionary conditions in Italy, in Spain, in Greece. Some country, somewhere along the line, some politician in one of those countries is highly likely to just come by and say, enough is enough. We're going to tear up this ECB treaty and default on the loans. So I'm actually expecting a destructive breakup, but it's not the only possibility. None of the possibilities are good, actually.
I would say the big risk to North Americans is, governments in Canada and the U.S. already have so-called bail-in legislation. If our banks get into trouble, they're allowed to dip into your bank account to settle the problem. And so the person putting in the deposit is taking all the risk. The banks get to keep all the profits they make, but if they start to lose money, they take your money. Is that the big risk here?
In Europe, yes. I don't see that here in the U.S. We still have FDIC, so unless that legislation has been rewritten, somebody told me, recently, but I've not seen it. So, but there definitely is bail-in chances in the Eurozone, in places like New Zealand that has it as well. The thing to do, actually, if it ever, comes to that, don't keep money in banks, period. Have treasuries, keep it somewhere else. And in fact, that is one of the reasons why, interest rates are negative all the way out to 5 years in Germany. Because by holding the treasuries, which people think can't default and money can't be confiscated, they just to make sure they can get their money back, they're willing to accept negative rates. That's exactly what's going on.
Mike, thanks very much for chatting with us.
A pleasure to be on the show, and readers can find me just by doing a Google search for Mish, M-I-S-H, right as we talked at the top of the hour.
Thanks a lot again.
We'll catch you. Happy New Year to all my Canadian listeners.
You can catch us on TalkDigitalNetwork.com. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.